Oi!
My name is Krishnan. I'm a PM at Doherty Advisors in New York, and I focus on volatility strategies with kind of an abiding interest in global macro. I focus on two areas, and one of them was reflected in my first book. And the idea there was, even though hedging is cheap in quiet markets, nobody seems to want to hedge when volatility is low and investors are complacent. So what can you do progressively as market conditions get worse to hedge in such a way that you don't overpay for insurance? So that was step one. Step two is more related to trying to identify market tremors or market weaknesses, structural problems in the system. And that's the focus of the second book, which will be called, appropriately enough, Market Tremors. Really what I'm focused on are situations where volatility is low, but the embedded risks in the system are high. So I've been trying to target things from an agent-based perspective. Now that sounds fancy, but really what I'm thinking of is trying to identify situations where markets aren't gyrating very much, but certain players in the market are becoming too big and too risky, and we're in a situation where a small move in prices could trigger a large sequence of events that could be very damaging in the markets. I did a post-mortem, like many other people did, on the Volmageddon in February 2018, and there it was fairly clear because you had ETNs dominating the system and trading according to fairly structured rules as per their prospectus. And you could almost say exactly how much the VIX would explode given an initial impulse or impetus. Here it's a bit more thorny because I'm delving now into the corporate bond markets, and I think the agents are more diverse, but the situation is pretty ugly. And I'll go into that in some detail. You now have a situation where the high yield markets in the US are about, let's say, 1.25 trillion in dollars. The ETFs, the high yield ETFs, which are predominantly the JNK and the HYG and a few others, they account for about 50 billion. Now you might say, well, that's small. That's about 4% of the whole market. But if you look through the structure, you look through the system, you'll see that things could get dicey very quickly. Now, why is that? ETFs are kind of chameleons, especially bond ETFs. The reference basket is a set of bonds, but they trade like shares. So people can easily get confused. And I've been a victim to this too. Looking at the realized vol of something like the HYG, which has historically been about 3%, at least since the recent bull market, and saying, oh, this is a stock, effectively, that spits out a high dividend and that can be traded in and out intraday with a refreshed quote every 15 seconds or so. And so all sorts of strategies that you wouldn't think would be possible in the bond market are now suddenly possible trading the HYG. This is a mistake. And the reason it's a mistake, and I want to pound home this point, that realized vol is not a true barometer of risk, by saying that this is a very illiquid market. What underpins many of these ETFs, especially in the fixed income space, is stuff that doesn't move. It's either closely held by pensions, insurance companies, and so on, or it's held by mutual funds who are very vulnerable to outflows. If you operate under the illusion that the ETF is trading like a share, you could be in for a rude awakening. Now, the question could arise, what could happen to the ETF? Why wouldn't the ETF trade in line with the reference index, and so on? There is a middleman in the ETF space, and that's the AP, or the set of APs, authorized participants. So basically when you buy an ETF, you're buying something that looks like a share, but there's an index provider, and then the provider, which could be a BlackRock or a Barclays or someone like that. And basically what they do is they appoint authorized participants to try and ensure that the ETF stays in line with the reference index. The authorized participants tend to be dealers in the space which the index is based on. Now, let's say that the ETF takes a hit. So it's trading far below the reference index value. In theory, the authorized participant should step in, buy the shares from the market at a discount, presumably, and then deliver them to the provider in exchange for a basket of bonds. So in theory, if the ETF drops 1% below the reference index, they'll go in, buy the bonds, or get the bonds delivered, and then sell them into the market for an arbitrage profit. But that's on the presumption that the bonds themselves are liquid. Now, these bonds are not very liquid, and what's happened in the marketplace is that the dealer community is no longer taking principal risk the way they used to. Now, you can look at this in the data. So the Federal Reserve Bank of New York publishes primary dealer statistics. And what you'll find is that across the fixed income space, but particularly in the higher yielding corporate bond space, dealers will not warehouse positions. So whereas they may have taken a 10 million slug of bonds previously on a sale, now they'll only take 1 or 2 million and then try and find a buyer for the rest. So this slows down the entire process. Now, the problem with this setup, and again, I want to bang this point home as hard as I can, is that you have high-frequency traders and other algos involved in the ETF, imagining that those ETFs are trading like shares, and at the same time, you have an illiquid reference basket. Now, you might say, well, how many flash crashes have there been? What could drive the ETF price down? One might naively think that we haven't seen anything since May of 2010. This is not true. We've looked through the data, and what we found is that if you look at limit down and limit up statistics, and you even take a semi-nasty month like December of 2018, it wasn't a horrific month. The S&P was down 9% or so. But what you'll find is that there were 500 instances of limit down circuit breaking events in December alone, which is a huge number. And many of these occurred in the bundled products, the ETFs and ETNs. So it's not hard to imagine that something like the HYG or the JNK could shank 5% and a circuit breaker would be triggered. Now, if that were the case, what would happen? Would the AP step in? Would the dealers who've been appointed by the provider step in, buy shares at a 5% discount, and then take delivery on the bonds? I would argue no. I don't think they would, because a 5% drop on a $50 billion ETN complex, or even on a smaller component, let's just take the HYG, would be at least a $1 to $2 billion sale of high-yield debt, would require that for the arbitrage mechanism to work. Now, you may then go in and say, well, bid-ask spreads seem tight. The high-yield bond market seems healthy. The corporate bond market at large seems healthy. Everyone is issuing corporate bonds. We've had this massive transformation where many corporations in their treasuries are acting aggressively. They're issuing corporate debt. They're either using it as a mechanism for the repo markets or simply as a way to buy back their shares or engage in other activities that are constricting the supply of stock and ballooning the supply of debt. In theory, this should mean that debt is attractive, it's abundant, and it's liquid. And again, if you go into the databases, you'll see tight bid-ask spreads. But again, one should not be confused. And as I've mentioned, ETFs give the illusion of a share price or a stock price world in an environment where the biggest growth area is bond ETFs. And when quotes are made in various databases for bonds, these are indicative only. There's no guarantee that you can get filled anywhere close to where the quotes are given. And it's well known that for illiquid assets, you'll have, say, 5 trading desks. And the first desk will be called, someone will want to sell some bonds or some inventory, and they'll call the first desk, and the first desk won't know what the price is, so they'll call the second desk. Second desk won't know, so they'll call the third desk, and you'll go around the circle. And finally, the fifth desk will call the first desk, and no one will be the wiser. And so no one really knows where the prices should be. No one knows how much depth is behind these quotes. And they're indicative only, they're not binding. So one can easily imagine a situation where a $2 billion sale of high-yield debt, if it were necessary, would trigger a 5-point down move in the reference basket of bonds. This would be disastrous. Investors are looking at things like the HYG and seeing a 3% volatility number around it, which is very low. Again, this is an illusion of safety in an environment where everybody thinks they can get out in time. I mean, the whole basis of this explosion in algorithmic approaches to risk is based on the idea that, oh yes, now we have all this data, so we can sample risk at higher and higher frequencies, so we can get out in time. So there's this notion that simply by having a quicker system, risk can be managed in real time. And again, this is the illusion of safety, because if everyone's doing it, one can imagine very, very sharp drops that occur more quickly than any risk management system can reasonably get out in. And so what you've got now is a situation where in markets like the high yield market, there's a real lack of true liquidity in the system. One of the important agents that I didn't mention is the mutual fund space. Now, if you think of the US high-yield bond space, as I mentioned, it's about 1.25 trillion in size, US. About 250 billion is held by mutual funds. And the interesting thing about the bond market that is not so true in the stock market is the way that mutual funds operate, and also the relationship between flows and performance. That's a key point. Now, for equity mutual funds, at least in the glory days of active investing, we can go into that too, there were enough Graham and Dodd type value investors out there that at least at some level they would provide a floor for the market. So if equities dropped enough, price to earnings would become attractive, or price to book, or anything that looks like price divided by 1 would drop enough, value-oriented investors would go in and buy. And they weren't so affected by outflows that they were handicapped in this way. So for example, the flow-performance relationship for equity funds historically has been concave. That's a fancy phrase. What does that mean? It means that for every percent of outperformance, the inflows are greater than for every percent of underperformance. So you get an asymmetry. Good performance is rewarded more than bad performance is penalized. In the bond markets, it's completely the opposite. Bonds are illiquid, so there's a first mover advantage to selling before everybody else does. And the flow-performance relation historically is concave. What that means is that bond investors, even the people investing in mutual funds over the longer term, let's say, are quick to get out if a fund is underperforming. And if you think of the high-yield market as a whole, as a segment of the bond market, a 5-point drop triggered by, say, a single ETF could trigger some significant outflows. And the back-of-the-envelope estimates that we've made suggest that a 5-point drop would probably lead to about a 1 to 2% level of redemptions from high-yield bond funds, which would trigger another potentially 5 or 10-point drop. So you could have a sequence of events going from the ETF that has a random flash crash. Again, I can't predict when or if this will happen. All I can say is that it has happened a lot recently, more than most people care to remember, even in the last year. And if it were to hit the high-yield complex, it would quickly funnel into the mutual fund space. Now, you might say, well, even taking that into account, we're only at about 300 billion total. Only is a strong word, I would say. But who holds the remainder? You've got these hold-to-maturity characters out there. I probably shouldn't call them characters, but they're pension funds, insurance companies, and other people who are trying to manage their duration risk. Now, we've had a few bullets which have been dodged in the past 4 or 5 years, especially in the public pension fund space in the US, where people have, or institutions have, quite a bit of latitude in terms of how they apply discount rates. Now, buying and holding to maturity corporate debt, especially high-yield debt, is a nice way to apply a good, fat discount rate to your liabilities, creating a better balance sheet situation, at least assuming no capital calls. These investors are unlikely to step into the market and act quickly. Now, there are buyers of last resort. Again, I won't go into the names. They might be hedge funds, they might be in the distressed space, and so on. But they're going to require a significant discount to come in and play. And if you think of the way that the corporate bond markets have been extremely compressed globally, but also in the US over the past many years, I could easily argue in terms of a major liquidation in the event of a 10-point down move, even if it's a flash move. Bond investors are not used to this. It's almost a new generation of players who haven't seen anything like this in the past 10 years. I would argue that this is a market where there are some significant market tremors. There are no indications of volatility in terms of realized movements, but there is significant downside risk. Now, the way I think about this is I'm trying to do responsible scaremongering. That's kind of my brand at this point. And responsible scaremongering to me means this. It doesn't mean that anything could happen at any time. Of course, that's true. What it means to me, though, is that if there were an initial move that were a random shock, maybe even within a normal distribution with a 3 to 5% volatility for the HYG, what can you see in terms of follow-through? What would the ramifications be? Who would be flushed out of the market? I can give you two examples. Imagine a situation where you have a single asset. There's just one asset in the world. It's trading at 100. But there are two scenarios. There are two parallel universes or planets, and the asset trades in both. In the first case, the volatility of the asset is, say, 5%, but there's no overhang. There's nobody who's levered and will be forced out if that asset goes to 95. In the second case, there's a whole series, there's a litany of stop losses, 5 points below or 3 points below. There are all of these people positioned where they have to get out if there's a down move. Which is riskier? In both scenarios, the vol is 5%, but in the second scenario, you can imagine a normal-sized random shock leading to a cascade of selling. That's what I'm looking at. That's what I'm thinking of in terms of agent-based risk. I'm not trying to solve the whole package here. I'm not saying who are all of the agents and how do they interact. I'm not coming up with a massively big data representation of the market. I know there are groups that do this. I believe they're getting some interesting theoretical results. But I'm more interested in what physicists might call a mean field problem, where you've got all these agents, and in classical economics, you think of all of the agents as being averageable. So each of them have slightly different constraints, preferences, and so forth, but you can still build an efficient frontier or whatever by just averaging them all together. And then the world of neoclassical economics emerges. I don't think that's a good place to be. It highly understates risk. It's a misrepresentation of changing structural dynamics in the system. But by the same token, I don't think the full-blooded agent-based representation is possible at this point. We don't know who all the agents are. We can't track all the transactions in real time and make sense of them in a holistic way. Whereas what we can do, and what I'm trying to do in a lot of the research I'm focused on, is to say, well, can we ever find situations where one or two agents become big enough that we can map them out, we can say what they're likely to do, and then average everybody else? So you kind of have two forces at play. One of them is a distribution that's generated from all of those neoclassical assumptions. You get a distribution, it generates normal-looking shocks. These are random. But then you have a few big agents that are emerging in the background, whether it's high-frequency traders in the ETF space for high-yield bonds, or it's somebody else. And you say, well, if there is a random shock, what's the follow-through likely to be? That's what I'm focused on. And I think the high-yield space is ripe for this, not because there's something imminent. Again, I'm focused on doing things responsibly, but where I can say something about initial random shocks having very negative consequences. This is very similar to the Volmageddon. There was a huge overhang of risk that was not being expressed because the market hadn't had an initial impetus that would drive it in that domain of danger. There's an important question, which is why should a sell-off in the credit markets be more persistently damaging than what we've seen in the equity markets over the past 8 to 10 years, where there have been lots of short-term, short-lived sell-offs that ultimately prove to be technical in nature rather than persistent. Well, as a macro investor, if I put my macro hat on, I would say that credit markets lead equity markets, not the other way around. And what happens in the credit markets has longer-lasting implications because it drives the amount of leverage that can be applied in the system. It affects institutional rebalancing. It has an impact on pension funds, on solvency issues, all sorts of things that short-term equity returns have less of an impact on. So for example, for equities, you can obviously adjust your risk premium after a sell-off. You can change assumptions that you make about your discount rate. For credit, it's a more definitive and long-lasting thing. When credit sells off, it affects valuations over the longer term. And given the fact that there's a lot of debt that's closely held and probably hasn't been marked to market in quite some time and may have been bought by a very small number of institutions or funds, one can imagine real defaults, material defaults occurring if credit gets marked down. And anecdotally, although I cannot provide hard evidence for this, there are quite a few high-yield issues that are technically in default right now, but which have not been repriced, which are held by, say, smaller distressed managers or mutual funds that could really have a major impact on the whole system if they were to have a mark-to-market update. Ultimately, it's important to put some numbers behind this because it has to be tradable, or it has to be at least comprehensible from a numerical standpoint. So the way I've looked at it is as follows. Assume a flash crash in one of the high-yield ETFs. So these high-yield ETFs are tier 1 securities. So a 5% circuit breaker would kick in. They're diversified enough that they don't have a 10% down circuit breaker. So assume that that 5% down move is hit. What would the repercussions be? Well, if HYG goes down 5%, it's fair enough to say that some of the other high-yield ETFs are going to go down quite substantially too. So if the authorized participant doesn't step in, if the dealers don't step in and buy the shares, collect the bonds, and sell them into the market, you're stuck with a non-functioning ETF complex. That's a disaster. There'll be an unwind which would cause probably another 10 to 15 point down move in the basket of bonds. Now, ultimately, I would expect the APs to step in. But if they do, I would argue that the high-frequency shank in the ETF is more representative of the true value of the bonds than the most recent print on the index. So if they do buy the shares, take delivery on the basket, and sell them into the market, I know there are technical issues about getting redemptions in kind or in cash and so on, but let's forget about that for a minute. I would expect at least a 5-point down move in the major high-yielding issues if they try and sell into the market. It's a forced sale. It's a diversified sale. It's well known in the bond space that selling one issue idiosyncratically may have less price impact than selling a diversified basket. Why? Because if you have to sell a one-off and there's no material event in the company, distressed buyers will come in and look to buy. They'll think it's a liquidity sale, a one-off, and they can buy at a discount. So you get a 5-point down move at least based on the arbitrage mechanism. Now, as I mentioned, the mutual funds then have, let's say, 1 to 2% underperformance in the high yield space. One could imagine even worse than that, because if high yield does sell off, one could anticipate a flight to quality into government debt. And the way that these studies are done are basically reflecting alpha relative to a diversified benchmark, not relative to a high yield benchmark. So you could expect a 1 to 2% negative alpha purely based on the flash crash, which would lead to another, let's say, $2 to $3 billion sale in the high yield space based on redemptions. which would, at least according to the people I've talked to, lead to another 5 to 10 point down move. So you're looking at 15 points of potential downside in the high yield space, which is looking like a 3% vol asset at this point in time. So you're looking at a mega standard deviation move that could occur within a few weeks. Now, ultimately, I would expect real money buyers to step in. But at what level? They've basically got the high yield market under their control at that point. They can pick their price. And the fact that the high yield bond sale transmission mechanism is so poor would, in my view, lead to a significant material down pricing or downdraft in high yield prices. Now, the question is, can you hedge this? Yes and no. There are some technical issues that make hedging, say the HYG, a bear or a nightmare. I'll give you one, and this is an issue that many people who buy puts don't realize, which is that there's a forward curve to buying puts. In other words, if you buy a put on a high-yielding asset, the forward curve will drift away from you over time. So as time goes by, if you buy a downside put on an ETF that's trading at 100 and has a 5% or 6% dividend, every year that nothing happens, I know that a year is a long time for hedging, the forward will drift away by that 5 or 6% from the strike. So you're losing money not only on time decay, but also on forward drift. This is something we try and take advantage of in different contexts, in different markets. But hedging directly in the high yield space is tough. It is cheap now from the standpoint of volatility being underpriced, but every day that goes by, you're getting dinged in two ways. You're getting dinged on time decay and also on roll down. That's an important factor that many people don't take into account. Now, my view on hedging is this. If things get really bad, it doesn't matter where you hedge. You're hedging against a systemic risk event. Now, if you view things in that context, you can hedge almost anywhere now. You can hedge in the currency markets, you can hedge in rates, you can hedge in equities. They're all the same thing. The only question is, will there be so much distortion in the rate space that hedging in fixed income is a futile thing? Now, I know that about a year or two ago, there were a variety of major hedge funds that decided to launch specialized products that would hedge against a spike in yields, a jump in interest rate vol, which would probably be accompanied by an upswing in yields. Now, we haven't seen that. We've seen gradual rallies in yields and then shocks to the downside when there were these mini flight to quality events. So you have this kind of highly rigged global system where everybody's yield curve is dampened, where there's, I don't know the exact number, but maybe 14 trillion US of negative yielding debt globally. I'm always using the dollar as a reference point, but globally there's a huge chunk of negative yielding debt. Yields have been managed up to this point. There hasn't been significant vol in that space, but I would guess that even equity hedging should work if there is a necessity for hedging high yield debt risk. Again, you may even have time to wait. One of the things that I like to focus on in terms of this second leg down hedging philosophy is that you don't need to be the first guy to the party, the first guy or girl to the party in terms of hedging. You can come in a little bit later if you make certain assumptions about the way that markets sell off. One of my favorite examples is kind of the Johnson & Johnson trade, where in 2008, if you looked at September of 2008, which was a bad month for equities, what you saw was that the riskiest names, if you looked cross-sectionally, the riskiest names, the ones with the highest implied vol going into the month, they had the biggest jump in implied vol. That's what one would expect. People rotate, or at least in the age of active management, which may or may not exist today, people would rotate from risky stocks to safe stocks, Johnson & Johnson, high dividend paying, as people have said, companies where if what the company sold dropped on your foot, it would hurt, those sorts of things, to safe stocks. But in October, quite the opposite occurred. And this is the main point. This is the second leg down philosophy. The stocks with the lowest vol going in had actually the highest increase in implied vol in absolute terms at the height of the crisis, at the height of the Lehman crisis. So what that means is that you do have a little bit of time if things are getting bad but are not horrendous, to pile into things that the market still thinks are safe but may ultimately be the riskiest if things do follow through. So I would not argue that you want to hedge in the fixed income space, but I would think diversified hedging in the equity space is a good play even against high yield debt issues. And so my goal in all of this is to identify areas where if there is a follow through, you can buy vol on the cheap today and profit massively based on a liquidation. So in a liquidation, basically the idea is that, or the underlying principle is that people don't sell selectively, they just sell whatever they have. It's a fire sale. So I would think hedging in the equity space is probably a good play. Historically, one would have argued that central banks have one hand tied behind their back because they cannot simultaneously control their currency and their yield curve. Somehow, by some miracle in the modern age, it seems conceivable that they can do both. This sort of drives us into the realms of MMT. I will not go there today. I'm sure you have many people who will argue much more vociferously for MMT than I will. But currencies and rates are probably harder to hedge in. I would focus on hedging in areas like the VIX or in the V2X or even in equity markets directly without focusing on these horrible bleed issues that you may have in the HYG space and places like that. Yes, if you're retail, you can hedge in the HYG. It's not super liquid to do so. It's much more liquid than it used to be, but you're paying 10-cent wide spreads at a minimum, and you're not going to get out very easily in a credit-related Armageddon. What are things that I don't like structurally? I don't like ETFs and ETNs. I feel there are lots of hidden dangers, and there's an environment where the people who are buying them don't know all the dangers embedded therein. I don't like the overhang in the credit markets. I'm uncomfortable with the ballooning or the burgeoning amount of BBB and lower issuance that's occurred over the past several years. I'm worried about the leveraged loan space. I'm worried about the pressures on active managers, both in the equity and in the bond mutual fund space. I'm worried about the embedded arbitrage mechanism in ETFs, the illusion that ETFs trade like shares, even when their reference basket is bonds. And if you put that toxic mix together, you can follow through a sequence which would lead to a fairly significant series of cascading sales, which would be a 8 to 10 standard deviation move, not that that's meaningful, in the high yield bond markets that could happen very quickly. So will it happen tomorrow? I don't know, but what I'm focused on is random shocks of normal size leading to sequences of sell-offs that can be incrementally tracked as they go through the system.